Craig Lemoine. Welcome to today's Land and Everything Else podcast, where we talk about the non-stock and bond side of investing. And today I've got one of my awesome colleagues, Joe Janzen.
Good to be here, Craig.
Thank you so much, Joe. We're really happy to have you. Joe, if you could introduce yourself a little bit, what you do here and
Absolutely. Yeah. So I am an agricultural economist in the Department of Ag and Consumer Economics here at the University of Illinois. My work mainly focuses on commodity markets. So thinking about, the price of corn and soybeans, especially, as like very important to the ag economy in the state of Illinois and really to the sort of the global market for food, fuel, and fiber.
So I wanted Joe to have you on today. Let's talk a little bit about commodity markets, right? So this podcast, we target an awful lot of people. In that group are financial advisors, registered reps, insurance agents, and then the people, maybe the intermediaries and products that they sell. And so, in the financial planning world and wealth management world, we sort of have a cursory view of commodity markets, right? In order to pass some of the securities exams, I have to know what a futures contract is. I have to know what a forward contract is. And maybe I need to know sort of how to long and short those products. Okay. That's about it. That's like the fundamental knowledge I need in order to sit
the
down
why and how of that is maybe a little bit
the why and how maybe and the actual markets with which I'm manipulating or not I'm like working on, right? Like we don't really need to know that. Okay. So you may wind up with 3 or 4 multiple choice questions in that area. If I'm teaching it to you, I may have 4 slides about that because there's so much else to cover, right? That I cram in there.
Sure.
So I wanted to let's unpack. Let's start with commodity markets because I think it's so important to understand sort of the underlying market demand supply that push pricing and land values and commodity prices and really ripple through wealth management, right? And to me, that's important. So where would you start a lesson? You're talking to a bunch of advisors. Share with us about what do we need to know about commodity markets that maybe we didn't learn in our FINRA review?
Yeah, so I think the important thing to remember is that these are physical assets that are really the building blocks of our global economy, right? So they kind of show up everywhere. Every firm, that's doing something kind of touches the commodity world in some way. But some people may be more exposed to that than others. They're sort of more close to the production, transportation and then like processing of these building blocks. So that's kind of the way I think of commodities, that they kind of touch everyone. And so I spend most of my time thinking about the fundamentals, the supply and demand for these things and how does their value get determined. The one thing is that makes these things commodities is that they are, produced and consumed in really competitive markets.
Okay.
So the tendency is for sort of a lot of the profitability to kind of be driven out of this because we've been producing, corn, soybeans, wheat, cattle, all these things for a long time. Right. And so we figured out pretty good ways to produce them, get them to the consumers who want to use them.
Okay.
And so in terms of, what's determining that price, it's sort of like who's the lowest cost producer, where does that supply come from? And then, how do we get it to the people who want to use it? And so that's kind of what I'm monitoring all the time is that supply and demand balance.
Okay. So when we talk a little bit about, markets and production, one of the elements that we're starting to see is more and more money go into what we might consider alternative investments, right? Mm-hmm. Which is sort of an ironic name, considering that, as you're talking, these alternative investments touch everybody at all times, right? And so I think that's sort of an interesting dynamic. But when we're looking for spots to invest or places to invest, and we look at commodity markets, like to some extent, what factors are in play? What elements should we be looking at? And, do I just say, okay, I'm going to buy a soybean ETF? Like where do I go from there?
Yeah, I think the thing to remember is that like these things are physical assets, and if we don't use them, they have no value.
Got it.
Right? So unlike holding like a brick of gold that we can sort of put in a warehouse somewhere and never touch it, and it will sort of retain its value, these are, tangible physical assets that need to get used. Okay. And so there are costs and benefits to being the person who owns that asset. And that's sort of kind of where I think so one thing I monitor a lot is the global inventories of these commodities. That's how we think about like how much of this stuff is there out there in the world and what should it be worth.
Okay.
But there are costs and benefits to holding that. And whether you invest in, physical commodities themselves, and most people don't want to do that because it seems, awkward, cumbersome, and costly, right?
Right.
I now have, 5,000 bushels of corn. Where am I going to put 5,000 bushels of corn? Do I just dump it in my backyard?
Right.
Obviously not. So there's a cost associated with holding on to that thing. And that kind of gets built into the pricing and kind of determines like the price of some of these kind of like ways that we've developed to allow investors to get exposure to commodities like an ETF, for example.
Okay. And I guess if you could walk through when we talk about commodities markets and we talk about it as a physical asset, right? Unlike necessarily a share of Google, right? That I can just kind of hold on to, and as Google has revenues, then they may reinvest the revenues, I may pay dividends on the revenues. But walk me through different players in a commodities market, right? Because let's say just hypothetically, you have a completely small, go back a few hundred years, right? You've got a miller and you've got a farmer, right?
Right.
Add on to that from there, right? Let's sort of
expand. Yeah. So I always go back to the farm gate, and that's sort of my background. I grew up on a farm. My dad and my brother still operate a farm up in Canada. So that's always the starting point. And that's really a lot of my research work kind of focuses on sort of how do farmers interact with these physical commodity markets. So I start there.
Okay.
Someone is producing this thing, but why?
Okay.
Well, because there's someone, out there in the world who wants this thing, who has some use value for it. So farmers are sort of dealing with a whole host of intermediaries. We might think of them as like grain elevators or sort of first handlers, people who are really kind of their job is to help aggregate this thing that's dispersed across a wide space. And we think about, why is that? Well, it's to do with land, right? The land that we need to produce this stuff is dispersed over a really wide space. So there's that sort of aggregation function, and then sort of a means of getting it to the people who can turn it into something that consumers want to buy.
Got it.
And typically most of these commodities, no one really wants to buy 5,000 bushels of corn for their own personal use, right? They want to buy all the things that we can make with the corn. And the same thing for cattle and energy commodities, all these things. So that's sort of there's this supply chain element, and then all of those people need to get compensated in some way for the value that they're adding to this commodity. That middle stage, that sort of first handler to processor stage, tends to be much more concentrated. So we have thousands, millions of farmers around the world. We have a much smaller number of handlers and processors. Because there are pretty big economies of scale in that kind of industry, and it's also quite competitive. So the profitability kind of gets bit out of that. So if we want to think of like one other way of exposing, getting exposure to commodities is sort of investing in the firms that handle and deal with commodities. Those businesses tend not to be sort of like the most sexy investments, because like their bread and butter is just sort of like figuring out where this thing is, how to get it to somewhere else as cheaply and quickly and efficiently as possible. And the margins in that business tend to be pretty small, and there's not sort of this like long run growth like we think this thing could 10x or 20x someday, right? Like Cargill, a very big and profitable business, a family owned company, so you can't directly invest in Cargill, but they've been around for 150 years. They've been trading commodities that entire time, but like the size of their company is not going to 10x because
or anything.
This market is not, all of a sudden food demand is not going to 10x.
Right. Not overnight.
Not overnight.
Right.
No,
maybe long-term trends, but that's predictable.
Yeah. But don't sort of expect that to like, oh, all of a sudden this thing is going to, take off, in the way that a software company might.
So walk us through, a little bit about pricing, right? Maybe pricing risk, and then of course how that impacts. And I'll kind of give you a hypothetical in the equity world, right?
Okay.
So in equities, let's just take example yesterday, right? We had a weaker jobs report, which means that we're more likely that the Fed stops raising rates and maybe drops rates, which makes money cheaper to borrow, which makes firms more profitable. So through that domino of events, we see markets go up 0.5%, 1%, something like that, right? That's kind of the end game of one report on jobs, which is always hard for me to get my arms around, but I think of at that point, like career-wise, where I can kind of see those dominoes. When we talk about commodity pricing, though, I feel like you start to have to look at dynamics like weather that maybe we don't look at in equity markets nearly as much. We need to start looking at maybe more global the dynamics to understand. And I guess if you could kind of walk us through other factors that maybe if I'm thinking with a stock brain, I need to think more globally.
So I think the key difference, so one is that maybe sort of like geographic scope. The other one that I think about a lot is sort of this temporal dimension. So we think about like the price of a share of Google.
Sure.
Determined by like what I think about Google's profitability now
Sure.
and into the future.
Yep.
And the commodities world is a little bit different because we're pricing the commodity, and what the futures market is doing, why we have a futures market, is to sort of price the value of this commodity at different points in time. So when I think about the price of corn today, say the cash price, if I drove up to a grain elevator outside of town here, and I said like, what are you paying for corn today? They'll tell me a price.
Okay.
But that price doesn't represent sort of what I think about the value of corn sort of generally out into the future. It represents really like
it is a right now, price. I will pay you this much for corn.
Yeah, exactly. Okay. So let's say that number is say $4.50 a bushel.
Okay.
So that's the number, but that is really all about what's the supply and demand balance right now.
At this moment.
At this very moment.
Okay.
And if I am sort of an investor if I want to sort of like invest in corn, I am thinking that's what it costs me to get the corn. And I have to think about, what do I think corn is going to be worth out into the future?
Right.
And broadly speaking, unlike a stock where I think like this thing might appreciate, in a meaningful way over a long period of time, right? Commodity prices tend to revert to this kind of like long run, low-ish level that's determined by, this competition in this market, who can produce this thing at lowest cost. So it's really more about understanding the difference between sort of like the stock of commodities and this flow as like we keep producing more and more over time. So that price doesn't sort of build in long run expectations. I think that's a key thing to think about. So then you think about, okay, so what's going to determine what the price of this thing is going to be worth 6 months from now, a year from now, 2 years from now. And so you might think, well, now it's harvest, like we've got lots of corn around. 6 months from now, it might be worth more.
Okay.
And that is, generally speaking, usually true, that there's this seasonal pattern in the corn market. But I can't just buy the commodity today, hold it till it gets to be more expensive, right? There are a whole bunch of costs associated with that. And those costs get built into the forward price or the price for delivery 6 months from now. So if everyone knows, hey, this is the typical seasonal pattern in the corn market, then they say, well, the price of corn for 6 months from now is already at this higher level. So you can't just buy corn for delivery 6 months from now and expect to buy it at the price today.
Right. So there's no easy arbitrage.
There's no easy arbitrage.
Right.
Like
you'd have to hold the corn for 6 months and then flip it, and the holding cost or complete economy of scale.
Yeah, right? Exactly. So this is sort of the there's no free lunch in the commodities market story that I
no, it's a great
have to break to your listeners.
I love that story. Now walk me through Think Global, right? Just kind of walk me through that, because I think when we look at asset allocation and strategic portfolio design, right, we've gotten to a point generally where we say, okay, domestic equities, domestic bonds are a portion, international, and then we kind of break the international down by developing markets and emerging markets, and we have for sort of fixed European, Asian markets, and we know that generally speaking, U.S. stocks and European stocks kind of walk in lockstep, and maybe not completely correlated, less so with emerging markets. So we understand a need to kind of have a global portfolio. But with a commodity, right, a soybean here is a soybean somewhere else, but at the same time, it is going to impact the price. So I wonder if you could share just kind of a little about why paying attention to the world matters in commodities.
Yeah, absolutely. And so that is definitely the case. And the dynamics of that really are sort of commodity specific. Okay. So we think about like the soybean market is a nice example because it's like relatively straightforward. There's one big country that really wants all the world's soybeans. That's China. Okay. There are really two places in the world where we produce most of the exportable supply. Okay. That's the United States and Brazil and Argentina. Okay. So but the pricing in those three markets is very closely tied together.
I would imagine it is, and if you have the same demand, right?
It's going to the same place. It's just sort of like who can get those things there the cheapest right now, okay, and who will be able to get it there cheaper in the future. And that's kind of the nature of that game. And so really you're watching supply and demand fundamentals in all of those places simultaneously. There's a lot of risk in that market because you're dealing with you are dealing with emerging markets like a place like China, but that's directly affecting what's going on here in the U.S. and getting information about Chinese commodity demand is really difficult. That's kind of like the dark arts of the commodity analysis world is like what's going on in a place like China where we have really relatively poor information. So we are, yes, constantly thinking about that. But if anything, the ties are sort of much more direct because it's really like we put this thing on a boat here in the United States. It takes a few weeks. We get it to China, and those two markets are pretty closely linked to each other.
So then let's say there's a drought or a flood in one of these three markets, right? So Brazil, Argentina here. Like let's say that there's a weather event, right? How does that shift everything around? Does it impact the price, or is it still kind of the same because of the same demand's occurring?
It definitely does.
Yeah.
I mean, that's the kind of thing that we're constantly monitoring. Is like, what's the weather in Brazil?
Sure. I hear that a lot around here.
Yeah, right? Actually,
it's very important.
Yeah, we talk a surprising amount about. Is it raining in Mato Grosso today?
Okay.
So that's true. That we're monitoring those things. The hard part about this is the effect of that weather event, say, is it raining in Brazil today, really depends on the state of how did we get to the point that we're at today. So how, and really the way that we think about that is, how much other supply do we have? What are inventory levels like?
Got
and
it.
If we're in a period where we have very low inventory levels, the effect of that one rainfall event can be very different than if the U.S. is sitting on abundant supplies and it can kind of step into that market and kind of fill the gap. And so that's sort of the interesting interplay that happens in these commodity markets all the time is sort of how do the events that we observe interact with the state of the world that we're in right now, which is different from the state of the world at any other moment in time.
I love that answer. So I want to kind of pivot. Let's and just kind of a hypothetical, right? So I'm reading the Wall Street Journal, and there's an article, and it's about coffee. I know coffee isn't your specialty, but just roll with me here on the conversation.
Yeah.
So I read about coffee, and they're like, more and more coffee drinkers are current in India. More and more people are starting to drink coffee.
Yeah.
We're a little worried about like an impact of a disease on the one strain of coffee in a certain area, and so we're worried about production of coffee, but we have more drinkers of coffee. So let's say I read this article. It's like 6 months ago. I did actually read the article. And I think, okay, well, maybe I want to profit on this conversation, right? Because that's going to make coffee cheaper for everybody. But you get the idea, right? I want to find a way then. And I know through our conversation today, I can't just go buy the coffee beans because now I've got to store the beans. And the idea of holding on to coffee beans for 5 years seems like they wouldn't be good anymore. I imagine they have a shelf life. So how would somebody go about, designing some elements of a portfolio if you did believe that trend, right? I mean, where do we actually start? Do I buy a some shares of a production company? Do I buy Starbucks? Like, where do I go from there?
Yeah, I think
just big picture, not
big picture.
Not investment advice.
Yeah, right. Like I think that the issue is like you could think about buying coffee futures, but that has all of these issues about holding costs. Right. That coffee futures contract represents, coffee at a particular moment in time. And whether this event, this sort of like long run demand trend,
let's call it
is like going to really pay off. Like, well, is it going to pay off at the time horizon over which that futures contract is specified?
Yeah.
Like, and do you want to bear the holding costs of, owning coffee over that same period? Probably not. So there might be a whole host of other means. I mean, one of them is buying shares in companies that would benefit from that long run trend.
So someone making the coffee,
growing
the coffee. I mean,
or growing and processing the coffee. I think both of those,
elements.
You see both of those sort of parts of the supply chain benefiting from that kind of trend. Then the other one is sort of like what kinds of things are going to be inputs in that production process, and so whether that's land or other productive assets that might benefit from a long run trend like that. But in terms of like, let's say the effect on coffee prices itself, I think, if we're reading it in the Wall Street Journal, I mean, the one thing is, right, that's something that people in the trade for that
people
business
in the know
are thinking about and are building into their own long run price projections.
Sure.
And so sort of thinking about, well, should the price of coffee be going up because I see this story in the Wall Street Journal, especially when it's one of these kind of like long run demand trends. I mean, those things kind of tend to take a while to play out. And there's a set of companies that might be maybe well poised to benefit from that.
Well poised before the story came out, right?
Indeed.
And have been thinking about this for decades, I would imagine.
Yeah. And so that's the fundamental difficulty of investing is sort of like, you can try to be first, you can try to be the smartest. I suppose you could try and cheat. We don't want to encourage that. No, being first is really hard.
Yeah. I love that perspective. So I have two more questions for you. We have about 5 minutes left. So two more questions. And I guess one is sort of the thought of the day, right? We talked a lot about inputs and supply and demand and geography and even weather, but what about interest rates, borrowing costs, right? And I guess to that extent on commodities markets, equities have seen as interest rates have gone up, we've definitely seen, equities go down. It costs more to make profit. How have commodities markets reacted to kind of the steep Fed interest rate hikes and was it as impactful, less, more? Does it matter by commodity?
It's going to affect different parts of the commodities business. Absolutely. Sure. The one way we see that is sort of in terms of thinking about, it's raising costs in this. And so what that's kind of going to do is not necessarily, raise or lower commodity prices, but it kind of widens out the gap between sort of the value of this thing at all the different stages of the supply chain, because everyone along that supply chain has to deal with these interest costs. So you think about, even something as simple as that, like, I'm going to buy this commodity and store it for 6 months. Well, now there's an opportunity cost associated with like sitting on the commodity for 6 months. I have to cover my capital costs to do that. And those capital costs just went up.
And so
now it kind of widens out those spreads between the value of the commodity today and the value of it 6 months from now.
And I would also think, it does sort of raise the price of production to some extent, because now if I'm going to borrow to plant seed, then I have to borrow at a higher rate, which means I have to, that whole domino effect is going to be slightly higher costs.
Absolutely. And the thing that we're kind of thinking about in the ag space specifically, especially here in the US, is like coming out of a set of years where agriculture has been relatively profitable. Farmers don't have huge borrowing at this point. Like operating, loan use is relatively low in historic terms, but it's like, how is this going to affect everything a year from now, 2 years from now, if we stay in a high interest rate environment?
Right. And I think that's the magic question for all markets, right? Bond stocks,
absolutely.
And I guess the last question we ask every guest is, what advice would you have for financial advisors that might be looking at alts or other products? What advice would you have for that?
Yeah, I think, there are interesting and novel ways to invest in this commodities space. And in general, the sort of move to financialize these markets has been helpful because it's sort of provided more liquidity. There's just sort of more trade, more active markets, and that's been great. But I think the returns to a lot of those commodity investors have been kind of disappointing because they've had to deal with some of these things like, the holding costs for commodities that maybe weren't sort of obvious at first blush. And so there's no sort of way to avoid all of the like difficulties with investing in alternative investments broadly, right? Those things don't go away just because we bring a new set of players to the market. They have to deal with those things too.
Well, Joe, I want to thank you so much for your time today. That was awesome. I learned a lot. I know our listeners learned a lot too. And thank you for joining us.
Oh, thanks, Greg. It was fun.